It's not my PC's fault. It's your podcast website fault.
Listen, I bet if I was listening to your PC right now, it would sound like Santa Claus that just ran up like 90 flights of stairs.
It is working hard.
Bet that thing's breathing heavy over there, isn't
It is. It's got long COVID.
it?
Welcome to the Money Huddle, a podcast that discusses financial topics for families, retirees, and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Advisory Alpha. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Advisory Alpha may maintain positions in securities discussed on the program.
All right. Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Ross Marinell. We're here to wrap up 2021. Ross, how you doing this morning, buddy?
Doing wonderful. It just feels crazy to say wrapping up 2021, doesn't it?
Yes.
Just I'm getting my years mixed up. But we've had an incredible year in market news, financial matters, retirement planning. Today, we're going to try and just put a little bow on it, a little year-end recap. We're going to touch on a lot of areas and move quickly through some of these topics. But we would be remiss if we didn't start with the Time Person of the Year. So did you
Yes.
see who Time named as Person of the Year this year?
I saw who it wasn't. It wasn't Elizabeth Warren. It was her, I think, her online sparring partner, Elon Musk. Was that right?
Her Twitter nemesis. So Elon Musk named Time Person of the Year. Of course, they want to grab somebody who can get attention and eyeballs to their magazine. No one seems to be more popular on the internet these days than Mr. Elon Musk, of course, leader of Tesla, SpaceX, and the cult following on Twitter.
And
And,
Dogecoin, apparently.
and yes, and occasional sales rep for
See
Dogecoin.
the Doge father?
He, the Doge father. So we secretly love Twitter trolls, right? Just internet
Yeah.
trolls in general.
I think it's hilarious, and I think that well, I think some people get on there just to say mean things. I'm not really a fan of
Sure.
those type of trolls, but like the people that don't take themselves too seriously and can take a joke and crack a joke, those people are fun.
It is wild to have the richest person in the United States engage on this level.
Yeah,
And obviously he's made some pretty extreme and wild and silly goofy points, but he's also made some really good ones. And he took not too kindly to Senator Warren's comments about him paying more taxes. Because in fact he has sold billions of dollars of stock
right.
this year, which when you want to tax ultra wealthy people, you want them to sell stock because they're not getting compensated through ordinary earned income like most of us. They are building their massive wealth through equity ownership of their businesses. And the
Sure.
one way that we can get tax revenue from them is for them to sell stock. So she picked a wrong time, the wrong year, I would say, to put him to task on that because he actually has sold a lot of stock this year.
Yeah, I think I saw a blurb where he's likely going to pay more tax this year than any American in history, like any individual American in history.
Right.
And of course, she's out there saying, we need to make sure that they pay their fair share, and it's just obscene. But we were talking about this previously, and this is where I stand on it now. I mean, you could take it as a political statement. You could not. But I'm done with listening to anyone in Congress talk about wealthy people and their stocks, especially since just this past week it was brought up about our congressional leadership, senators and representatives, being able to trade and own individual stocks. And Nancy Pelosi basically like rebuffed that and said, no, it's we're for free markets. When if you look at her husband and some of the trades that he has made and the timing of some of the trades he's made, but I won't single her out because this is on both sides of the aisle. The Republicans do it and the Democrats do it. They do essentially what is tantamount to insider trading up in Congress. And the fact that they want to come out and have like this holier than thou opinion about people in the private sector making money, I'm just done with it all. I'm like, you know what, you don't have any legs to stand on. It's all political, double speak, and trying to whip up your base against somebody else, because Congress is doing some ridiculous stuff that, quite frankly, Ross, if you and I did it, we'd be in jail. So there's that.
Well, on the heels of federal bank board members trading ahead of significantly important policy decisions, can't wait a day or two for news to become public. It's hard to even fathom.
Oh, of
And
course.
of course, the Wall Street Journal had a really deep investigative report on the trading of federal judges when they're overseeing cases and actively buying stocks in businesses that they are involved in the decision making of what happens. And it just seems ridiculous. And so, all right, moving on. Elon wins Twitter. He is Time Person of the Year. They probably picked the right person to get my eyeballs to their page. So let's move on. We had some announcements from the Fed. They had their recent statement. This is your favorite time of the year, when all eyeballs are on the Federal Reserve and their policy commentary. But we have had a lot of macro shifts this year. In particular, 2021, we have had a rise in inflation. It has become the latest report now puts us into the highest inflation we've had in 40 years. So this is news. I mean, this is affecting people's lives. It's affecting our costs at the pump, food. If you run a business, it's affecting your ability to get the materials you need to do your job at the same price. We're seeing costs of costs of product go up. And so the Fed this week made it clear they were going to end bond buying most likely by Q1 2022. And then they foresee 3 rate hikes next year. What are your thoughts on the Fed's latest commentary and their hopefully tactics to slow this inflation?
Well, I mean, I think they're doing what they feel like they have to, right? One of the mandates of the Fed is trying to control inflation, and clearly inflation is not under control. And if you look at what's going on, for the most part, yes, there's some economic data that is not super strong, but for the most part, you can see that there is a recovery, even if it's a little soft in some areas. There is a recovery, and we had just such a significant event that has impacted our economy in so many different ways. So it's going to take a little while for things to kind of shake out. But I think the biggest thing is, for one, inflation is definitely within their mandate. So they've got to do something. And secondly, inflation is a serious tax on a lot of people. A lot of times when we talk about the economy, when we talk about the stock market, we're not really talking about everybody, because as we discussed before on the show, not everybody owns stocks. There's a significant amount of people in our country that don't own investable assets, but they go to the grocery store. They're trying to put food on their table for their kids. They go to the gas station. They feel like, they need to be able to earn a wage that can keep up with their cost of living. And so inflation really hits those families and those households a lot harder. And so there is some political, color to that, but there's also just the fact that, if they can't get this genie back in the bottle or under control, we're going to have real problems. So I think they're doing what they've got. They feel like they need to do. His comments were a little, he did leave the door open that if they needed to go back to providing more accommodation because of, the Omicron variant or something else, that they were willing to do that. But I think, this is a meaningful
Will
step.
that door ever be closed? I mean, realistically,
I don't know. I think that it'll eventually have to close, because I think at some point we're going to have to reconcile that virus is not going away. We're just going to have to continue to work on therapeutics and treatment protocols where, it just becomes part of life. And, we have the rapid tests, and, just like the flu, you figure out how to live with it.
Going back to a good point you made, for folks out there that don't own stocks, that don't own real assets like a home, where if they're renting, maybe they don't have the cash flow to invest in stocks, they haven't seen the price appreciation that others have. If you own stocks over the last 16, 18 months, then you've probably done well. If you've owned a home, you might see that your home value was approaching its all-time high.
Right.
depending on the area that you live in. Certainly here in the Carolinas, it's been wonderful for folks that own stocks and own homes. If you don't and you found yourself missing out on that, then all you get is the other end of the stick, which is higher gas prices, higher food prices. I will make this point. So this came out. Liz Ann Saunders tweeted this. She said, last time CPI inflation was this high, the 10-year treasury yield was above 14%, and personal savings rate was just above 12. So now the 10-year, as we know, is still hovering like under 1.4. So we're having this really significant increase in inflation, but rates are low.
Right.
And this is different than, well, we would never say it's different this time, right? But this is a diversion from the last time we've seen inflation at this rate. So just to keep that in mind. All right. So the Fed made their announcement, and hopefully that can kind of cool that they laid out their roadmap. We'll see if they follow it, but hopefully we can put the Fed in the rearview mirror for a little while.
That would be nice.
That would be nice. So moving on to and getting back to some of the stock activity, specifically some of the new SPAC and IPO issues this year, and some of the meme stock we are starting to see as in kind of related to the Federal Reserve policy. We're seeing some hyper growth sales companies with, let's say, distant profits, where they're not profitable now, but they may be profitable in 5 years, from now, 7 years.
How distant are we saying here, Mister?
Ooh, some are pretty distant, but we have seen those bubbles burst. I think one of the stories we'll look back on this year is the IPO face plants, just absolute face plants that we've seen this year, and some of the fintech, so the financial technology sector that's just been very popular. Businesses like Coinbase, Robinhood, coming out of the gates, and just the stock's going nowhere. People are now maybe for the first time absorbing what it's like to be in a market that goes both ways. A lot of people started investing, after the COVID market decline, and you see your stocks just roll up for a year, and then guess what? Didn't happen this year, did it?
Yeah, I mean, there are a lot of people that got involved in, and I don't want to say, I guess we could be technically correct by saying investing, but I think a lot of what we've seen is gambling. People basically taking stimulus money, taking extra, money that they have. Maybe they were working, but they still received, stimulus payments, and, rolling the dice with it. And anytime you see gains being, outsized versus like the risk that's being taken, those types of scenarios tend to revert. And, especially when the capital dries up. I mean, because, if the government was still sending out stimulus checks, we'd probably still see some of that. But, the stimulus payments dried up, the enhanced unemployment stopped, unemployment's starting to get more normalized. I wouldn't say it's normalized yet, but it's getting more back to the normalized trend. So, some of this extra money that people have had to throw at these ideas, be it a GameStop or an AMC meme stock, type of thing, to any, your crypto token of choice, to a SPAC. I mean, anything where you could get just exponential upside and your risk is minimal because you don't really have the mindset that it was your money anyway. This is what we see, and it's still playing out, and it's moving all through the universe. We still have NFTs and people buying, JPEGs of art, quote in air quotes, art, for ridiculous sums of money. But this was a wild year, and I think we're going to see more of it in the future.
You made an interesting comment on the unemployment numbers and people getting back to work. So in Jerome Powell's last statement, he actually specified that prime age employment was kind of returning back to normal.
Mm-hmm.
I thought that's an interesting distinction, prime age employment. So I guess if you look at the extremes, like the people just coming into the workforce, those leaving, we know that there's been a big transition this year of people advancing into retirement. So maybe they aren't at their full retirement age, but they were in that retirement window, maybe 1 to 2 years left. This was a wonderful, this was a good opportunity to make that decision to retire. Going back to what we just talked about with portfolios and home values and all of it combined. And then you're looking at the younger side. Well, if you were getting that stimulus money last year, you didn't have to pay student loans. Some people weren't in a position where they had to pay rent, and the government's mailing you, and you're getting more money, to sit at home than you would going back to work and paying your bills normally. Then yeah, you have a little extra capital to put into the market ideas that are attractive to a younger investor like that. And some of the most popular stocks, the meme stocks, have had a different experience this year than the previous year. I'm just thinking about companies like Peloton, Wish, Pens. You talked about AMC. We saw again Robinhood, Coinbase. These are businesses that are getting penetration in their market. Coinbase is a very popular exchange. It's huge, right?
Sure.
I mean, it has a lot of users. Robinhood is attracting investor accounts in a rapid pace, but it doesn't mean just because it's a popular company that the stock is priced correctly. And so we're seeing pretty big divergence. And I think this is the year, Michael, we're going to learn about the dangers of leverage on a retail basis.
You think we're finally going to learn the dangers of leverage?
I
I think it's like I remember the story when we were kids growing up. My family, we all went out to a Japanese steakhouse, and my sister, I can't remember
I'm
how
so
old she
excited for this
was.
story. I don't know what you're
She
going to say, but I'm ready.
we're all there, we're getting ready, and the chef comes out and he starts like doing his thing. And I remember my sister, for whatever reason, she just decided to put her hand on the table. And so if you're in the
Ooh,
people who have never been to a Japanese steakhouse, the table is actually where they cook the food. So it was like,
yes.
she put her hand on the stovetop, if you will, or the grill. And so she burned her hand. Thankfully, it wasn't a severe burn, but I mean, she burned her hand. So she learned about that. But how many other, kids out there have not yet done that are going to still do it? And so that's how I feel about leverage. Like there's going to be people that are going to learn their lesson, but then, part of our arrogance as humans sometimes is to think, what? Oh, well, that won't happen to me, or I'm going to do it differently than these other people, so it's not going to happen to me. And I just feel like it's like a drug that's out there for the taking. There's going to always be people ready to, ready to dip their toe in and think that they've got a better system than others that come before them.
And I also think too, when it comes to some of these newer businesses that are getting a lot of discussion on stock boards and they're very popular, they also start to garner regulatory scrutiny as well. And so we know that Robinhood is trying to debate, how do we create business? Do we sell? Do we get payment for order flow? Are we going to see a return of trading fees again, just to have a more transparent cost? I do think there are some challenges that they're going to face just from how they're growing their business. This came across CNBC today that was talking about buy now, pay later stocks. And so some of those popular ones referenced in this article: Affirm, Afterpay, Klarna, PayPal, Zip. This is the CNBC lead. The Consumer Financial Protection Bureau is seeking information from those companies on the risks and benefits of their products. Buy now, pay later, quote unquote, services let shoppers defer payment for items, typically over a period of monthly installments and with no interest attached. So that's the headline from CNBC. So the Consumer Financial Protection Bureau is concerned that people are going to borrow more than they can eventually repay, because that initial purchase is spread out over monthly payments. Mm-hmm. But in some cases, and I don't know that this is true in all cases, but in some cases there's zero interest.
Well, I'll be curious to see. I don't know a ton about this business model, but obviously, if you've got credit card companies out there charging 20%, and then you have these tech platforms that can figure out a way to come in and undercut that margin, there's a market for that, of course. The other thing I was curious about is, if they're not going to charge interest, would there be a markup in the price of the items that people are purchasing? Because if there isn't, then the question is, well, how are they making money? What are they doing, that they're not telling us? So that would be interesting to kind of figure out, like, how they're making that sausage.
Right. And what kind of I circle back to is a lot of these new issue the new issued businesses, they come up with a new wording for something that's been around forever. Buy now, pay later. So it's got this cool, oh, BNPL. Let's got this little acronym. It's great. It's a credit card. I mean,
It's
this isn't
layaway.
a new idea, right? I mean, stuff's been
It's
around
just
for
not.
decades.
We're not going to call it layaway anymore. We're going to
So,
call it buy it now, pay
so
later.
it's like, the Consumer Financial Protection Bureau is going to investigate people buying more than they can afford to pay off. I'm like, oh, that's a novel idea. I mean, it's been going on for centuries, but okay, I guess we'll look at it. A funny stat. So, looking at Berkshire Hathaway this year compared to ARK. So, ARKK, that's Kathy Wood's famous fund that she's had a great run in, but run into a little turbulence this year versus Berkshire Hathaway, of course, Warren Buffett, Charlie Munger,
Right.
BRK.B. Old Uncle Warren is reclaimed the return lead this year pretty dramatically. Now, not
Sure.
over a longer, short. I think if you look back 3 years with Kathy, her fund still is doing really well, but it's definitely having a little trouble this year.
Well, I think, the underlying lesson here is that I would hope anyone listening take away is, if you are going to go after if you're going to go after outsized returns, you want to try to beat the market. And when I mean the market, I mean whatever your benchmark is. So if you want to beat like large cap stocks, or if you want to beat, the tech stocks, you're going to have to you invest differently than what the market is doing. You're going to have to take risks where you are skewing your portfolio or your holdings differently, and with that you have the option or the potential to have years where you do outperform, but then you also are going to have years where you underperform, because that's part of it, I mean. And because different sectors that run on different business cycles, different outside factors that can influence. I mean, just think about last year, what the impact of last year 2020 had on the tech sector, where everybody was forced into using technology in ways that they likely used, in a limited fashion or not ever before. I mean, how many people had to
Mm-hmm.
figure out Zoom last year, or, Google Meetings, or to figure out, how to run their company, from a virtual manner, where before they weren't doing that. So that had tremendous implications for people that were heavily invested in technology. And then, of course, this year, at least in the first part of the year, where it looked like we were going to be, just reopening and life getting back to normal, then you have the reopen trade, where everyone's thinking like, oh, hotels, cruise lines, airlines, things that people need to use, tangible durable goods, all these things people are getting back into. And so there's cycles to everything. And so that's the thing you have to be mindful of when you're trying to allocate capital, is if you're trying to be active in your choices, then you're going to have years where you underperform. And so it'll be interesting to see if Kathy would make some changes to her fund, or everyone's waiting on to figure out what the next big move for Warren is. But I think Berkshire's, I think he's kind of run his course over at Berkshire.
We'll see. I think this is almost the tortoise and the hare,
Yeah.
and Berkshire is calculated. They're shrewd and world class, sharp, intelligent investors, and they may not make splashy buys in newfound technology, but they search out tried and true businesses that return capital. And on a long enough time horizon, they're tough to beat. And I just think from the mindset of how to build wealth and accumulate and prepare for retirement, I feel like our younger generation is in a hurry. It's today, it's leverage, it's get in and trade and move and fast. And it's got to be now, now, now. And sometimes the wisdom of knowing that it may take a decade, 2, 3, 4, but you have the time, and to be patient and to be, but have a determined mindset. That doesn't mean just because Berkshire isn't going out and buying Teladoc stock and some of these high flying companies doesn't mean they're not trying to return the maximum level of capital that they can to their investors based on their investment policy. And so they just had a different time horizon. They didn't need 6 months. They're looking
Yeah,
at a longer time horizon.
I agree with that. When you're looking at an investor, you have to understand what they're doing. And if you want just a fun homework assignment, Google how much dividends and interest that Berkshire gets from their Apple holding. It's insane. So,
Right.
you know, again, let's not pretend that we're Warren Buffett. You, the listener, are not Warren Buffett. Maybe you will be, but you won't know for 80 years. Okay. So let's not pretend that we're Warren Buffett. Let's focus on what your goals are and what you should be doing for your own investment path moving forward. Not focusing on what Warren Buffett's doing, because your portfolios are not the same.
All right. So next topic. So this is looking back over the last year, our employment landscape, work-life balance. Is it forever changed? Will we ever see a mass return to full-time in the office again?
I can't imagine that we would.
Stuck in traffic, right? Listening to radio, drinking coffee on the way to work.
Listening to our podcast on the way to work.
Right, you listen to it at home now.
Right.
It's over. In my prediction, there will never be a return to in-office work in the environment that we were pre-COVID.
Yeah, I think it's forever changed, and there's some good things to that, and I think there's going to be some really interesting challenges that arise. Number one is when you are, when you're an employer where you have a footprint in a certain geographic area and you source all your talent from that area, and you no longer have to do that, how do you structure your compensation to reflect, let's say, for example, someone had to be in San Francisco to work at a specific company, but now they can hire somebody to do that job in Nebraska. Do you pay the person who's living in Nebraska the same wages that you would pay somebody that has to live in San Francisco? Because the cost of living in Nebraska is probably less than the cost of living in San Francisco. That's going to be an interesting thing to see how these companies sort out. The other thing is, I think we're probably going to have a hybrid type of environment where you're going to have some positions where the people can completely work remotely, some positions where it's a hybrid type of environment, or a choice of a hybrid environment where they're in the office a couple of days a week and then they're at home a couple of days a week, and allowing some flexibility. And then the other thing I would say is this, is if technology arises to the point where you can basically hire almost anywhere, how do we not move into a globally competitive environment where some people that used to not have to worry about competing with workers overseas or in other countries for their jobs now have to do that because it's going to be completely remote? It's going to be interesting to watch.
So this year we saw what was dubbed the Great Resignation. More people changing jobs this year than I think in any period on record, to the same reason.
Right.
Changing work environments, finding a better work-life fit, walking away from in-office jobs to find other career paths where they didn't have to travel, changing jobs because companies were offering more money. Even on the service sector side, if you could make $15 an hour at a fast food chain and someone else offers you 18, you leave. Right. Because why not? Why not go make the most amount of money? We know employers were offering bonuses to attract new talent and to keep people. So could you flip your job, make a little more money and get a bonus? You're doing it. So people moved in mass this year. Big job change, still job openings that may take years to fill.
Sure.
Now we have the Fed, as we mentioned earlier, talking about prime age employment because they may be looking at the other ends of the spectrum and going, we can't fix it. So they're minimizing the problem to the age gap where you would expect people to still be working.
Mm-hmm. Well, you think about this. I mean, this is not to get overly granular on what may have happened, but you also have to think like last year. I mean, people got forced out of the office, and there's a lot of people that were working that we've talked about this that decided to go ahead and retire. They felt like they had accumulated enough in their retirement accounts to be able to do that. They relaxed some of the rules last year where people could get access to 401k money, IRA money, and spread the tax burden over a 3-year period. There were a lot of interesting planning opportunities that could have arose out of last year alone. And then this year, people going into a, like that hybrid work from home environment. And then they were told they were going to go back to the office, and they say, you know what? No, I'm willing to, shrink my budget a little bit and go ahead and retire a little early. There's a lot of things that happened. And so it's going to be interesting to watch how these employers deal with and the changing environment. And I think a lot of people left, the service sector completely, like, got put on pause for a significant portion of last year. And so some of those people, they may have decided, you know what, I'm out of the service sector. I'm going to go get another job and something a little bit more stable. So it's going to be interesting to watch, because I think we're going to see the effects of this year going for a while.
It'll be curious to see if the new job creation, just people going out there and forming their own businesses. So new businesses starting up during the lockdown, people are at home, they maybe have a passion they want to follow a little bit. Be curious to see how those continue throughout the next year or two. Are they sustainable? Are they able to make enough income from that to live and support themselves, or do they have to return back to a more traditional job? Also think about all of the financial decisions that have to be made during a job transition.
Oh yeah.
So what do I do with my old 401k? What do I do with my new 401k? What are my contribution levels? What are my insurance benefits? What life insurance policies are portable versus do I need to go get a new group life insurance? There's a whole host of financial decisions that have to be made related to those job changes. And when you see the level that we've seen this year, you've got to think there's opportunity there for people to really fine tune what they're doing financially. So I always love this time of the year to just sit down and do a recap of what policies do we own, what worker benefits do we have, what contribution levels are we making to retirement plans?
Right.
Is that working for your cash flow? Can you do more? Where do you go from there? I just think this time of the year is always the best to just sit down and reflect on some of that.
Absolutely.
The next topic I had was, so this year we saw Facebook change their company name. They're now Meta. We are on the fast track to the metaverse. Are we excited about the digital economy? What do we call this when we're just living in the cloud?
See, like you almost faked me out there, because you asked me if I was excited about the digital economy, and I thought you were about to ask me if I was excited about the metaverse. And so digital economy, it does excite me to some extent.
Okay.
There's opportunities. The metaverse, I'm not excited about it all.
I've documented on this podcast that my oldest daughter loves to play Roblox.
Yeah.
Roblox is one of these sort of metaverse type environments where you have your little avatar, you go around, you build property. It's almost like a Sims to those Gen X out there that would understand. But there are certain things that you have to buy with Robux, which is really mom and dad are going to chunk in a little money. And for you to build out your metaverse lifestyle, it's not just your creative brain, it's also the dollars behind it. Right. And do we see the metaverse shaping up to be just one big advertising filled virtual world where we're literally, like, you've seen these videos that Zuckerberg has posted, right? Where he's running around his little metaverse.
I try not to.
Is it really happening?
Yeah, it's going to happen. I mean, I think that there's clearly an appetite for it, and there's going to be some people, I think, that completely want to live their life virtually in this virtual world that they can create. I'm just not there, man.
People are going to be buying Nikes and Starbucks in the metaverse.
That's so silly.
To put like shoes on your character that you're going to run around. That's you.
Yeah, maybe it's just the dad in me, where I've got like real kids that like want to eat real food and need real clothes. So, I mean, I don't know. I think that there's, like anything else, there's going to be some really interesting opportunities that are created by the technologies. And then there's just going to be stuff that doesn't make sense. Like, I'm not a huge video game person, but now we have esports teams, and like younger kids are like, they're hugely into it. And okay, that's great. But we also have to live in the real world. Like, there's life that has to happen out here in the real world. So I'm going to be cautiously optimistic about some of the potential, and I'm going to be highly skeptical about this being just some kind of virtual reality where people go to escape, their real life.
Almost like going to the movies when we were growing up. Is that what you're thinking?
But you don't. But when you go to the movies, you understand that like you're going there just to be entertained and be part of a story. You're not going there to like be in the movie and like unzip yourself out of your real world life and go live a virtual life, someplace that doesn't really exist. I'm just like I said, it's new, and I feel like an old dad over here, but at the same time, I mean, there's going to be some people that love it, and there's going to be opportunities that arise out of it, and we'll see what happens.
I was sitting in a conference room, sitting in the conference room the other day, having a little chat, and I was talking to somebody. He's like, I don't like to text. I was like, I like that. Just forget it.
Yeah.
Like he's like, look, I'm good with email. That's where I'm stopping. It's like, look, he drew a line in the sand. He's like, that's it. You want to talk to me? You email me. Not getting into all the other technology. Talking about product ad placement, because I can just imagine the metaverse being filled with corporate advertisements. What did you think about Mr. Big dying on a Peloton in this Sex in the City?
I thought that was hilarious. I would wager that that's probably not the product placement that Peloton thought they were signing up for on that show. But man, if you want to talk about turning lemons to lemonade, the Peloton commercial that they ran with Big and his instructor, like kind of, they really took full advantage of the publicity that was generating.
So Cam is a terrible passer of the football. Can we say just put it out there for one last time? We love him. He's a great guy, great leader, alpha, right? He's got moxie. He just can't throw the ball.
There's something there. And it's always been there with, I mean, he was never a phenomenal passer. He was a dual threat quarterback. I watched him like overthrow receivers for years, but it hurts a little more this year, especially when we really needed him to come in and provide us a little lift. It was short-lived, but again, he's had a great career. I don't know that he's a franchise quarterback anymore for the NFL. So we'll see.
Starting quarterback.
Yeah, and he was such a huge superstar that I don't know how a player like that goes into playing backup. I mean, I think he just hangs it up and says, my career is done, and maybe he goes into coaching. I don't know what his interests are outside of. I mean, I know he's got foundations and he runs camps and stuff, and he's got a huge heart for kids. So maybe he gets involved. Yeah, maybe he gets involved in that.
Okay, this is our annual reminder. You don't have to pay attention to any economic forecast for 2022 because they have no idea.
Period.
End of sentence. Just don't even waste time. They don't know. When we're sitting here talking about looking back, you can make heads or tails of it looking in the rearview mirror. Going forward, we don't know.
Everyone's gonna make their projection though. That's not gonna stop people from writing those forecasts.
It's crazy. It's like silly. They make an S&P 500 prediction. Why? It's just worthless.
Yeah,
just don't even read it. Just stop writing it.
Absolutely, I'm with that.
All right, my man. Well, the last thing I'll say is this: the rise of the independent media is going to continue.
Oh, 100%.
That's a prediction I'll make.
100%.
Can't stop it now.
Well, I mean, if you look at how corporate controlled our mainstream media is, where basically they're all trying to package the same talking points and content in such ways that reflect whatever the bias or the viewpoint that they're trying to show. I think more and more people are going to seek out, I don't want to use the word influencer, but sure, influencers, their own, trusted sources or trusted folks to talk about, different things and to be more objective. I think there's a huge appetite for that right now.
A big void in that.
Who would have thought that Joe Rogan would become the gargantuan voice on platforms just because he's curious? He has interesting guests. He's curious. He's not afraid to ask questions. He's not afraid of cancel culture. And this guy is, I think, the number one podcast in the world.
So yes,
it's
no doubt.
It shows you that people are wanting to hear various different viewpoints, and they gravitate towards somebody who's actually not afraid to ask real questions.
You can use fake dog money to buy a Tesla.
according to Times Person of the Year, I think you can. Well, I'll say one thing, and we can wrap, because this is fun. I know a lot of people are probably, making plans if they're not already on their way to, their Christmas destination. So we hope you have a wonderful holiday. But let's not forget there was a horrible, horrible tragedy in Kentucky recently. We had tornadoes come through, and I saw this article on Wall Street Journal, and it made me think, because it was talking about the scope of the devastation of the tornadoes. And it says that the insurance payouts for that are on track to hit $5 billion. Right below that, when the article started out, it talked about the devastation and how the insurance companies were kind of offsetting, their payouts with, higher deductibles, which that's kind of how insurance works. And I think a lot of people miss that. And I wanted to correlate it to the people who listen to our podcast, because one of the most important things that folks think about when they are getting ready to retire is market risk, and how like a bad market shock could really injure their portfolio. So think about it like this tornado. I mean, if you live in Tornado Alley or a place, tornadoes are always a possibility, but they're not commonplace, or else you wouldn't build your house there. But something catastrophic could be tremendous, and having insurance or protection is one of those ways you hedge against that. And so for folks that, where running out of money in retirement could be catastrophic, or running out of assets, or not having enough income or assets so that you can retire could be catastrophic. One of those things you can think about is, how do you protect yourself from that? What are some things you can do from a financial planning standpoint to hedge against those big tail risk events? And so, our hearts go out to the people in Kentucky. I hope that our federal government can help them get resources and disaster resources in place to help those people. Horrible thing to have to deal with, especially right before Christmas. But yeah, this year has been a wild ride, 100%. And here's a forecast for 2022. It's gonna have its moments too, man. That's just the way the world works.
I appreciate everybody coming along the ride with us and listening to our podcast throughout the year. We've had the most incredible 2 years with our clients, and getting to know them better and see so many people through to retirement. It's unbelievable the way this has worked out. If you would have told me in March of 2020, I would have never believed you.
Yeah, this was fun. Well, for everyone listening, we hope you have a Merry Christmas, and we will be back with podcasts in the first part of 2022. So have a Merry Christmas, a Happy New Year, and we'll see you next year.